The next year could be the year where the market can crash badly. Are you prepared? As we look ahead, we see a potential storm brewing on the horizon. The year 2024, it seems, could be a tumultuous time for the global economy. It's not a prophecy of doom, rather an observation based on market indicators that are flashing red. The first of these indicators is the growing disparity between the stock market and the real economy. While stock prices are soaring, the real economy, the one that affects everyday people, is struggling to keep up. Unemployment rates are high, and many businesses are still recovering from the ongoing effects of the pandemic. This disparity is a classic sign of inflated market, which often precedes a crash. Secondly, there is the issue of rising inflation. Central banks around the world have been pumping money into their economies to keep them afloat during the pandemic. However, this influx of cash can lead to inflation, which in turn can trigger a market crash. Another factor to consider is the global debt. Countries around the world have taken on massive amounts of debt to deal with the economic fallout from the pandemic. This debt will need to be repaid, and that could lead to a tightening of financial conditions, which can send shockwaves through the financial markets. Lastly, we have to consider the geopolitical tensions that are currently brewing. Trade wars, political instability, and conflicts can all have a significant impact on the global economy and the stock market. All these factors combined create a potent cocktail that could lead to a market crash in 2024. The consequences of such a crash would be far-reaching. It could lead to a global recession, similar to the one we saw in 2008. Millions of people could lose their jobs, and many businesses could go under. But how does this impending crash compare to the one we experienced in 2008? Let's dive deeper. To understand what we might be heading into, we need to look back at the market crash of 2008, a year that became a defining moment in the history of global finance. It was not just a year of financial crisis, but a year that changed the way we perceive and interact with the world of finance. The 2008 crash was triggered by a perfect storm of factors, but the most significant catalyst was the housing bubble burst in the United States. This was a result of risky lending practices, where banks were offering loans to individuals who couldn't afford them. When these individuals started defaulting on their loans, the banks found themselves in the midst of a crisis. It was like a house of cards. Once one card fell, the whole structure collapsed. The effects of the 2008 crash were far-reaching. It wasn't just Wall Street that felt the burn, but economies around the globe. Stock markets plummeted, businesses went under, and millions of people lost their jobs. The world economy went into a state of shock, and the recovery process was slow and painful. Governments and central banks worldwide intervened, injecting trillions of dollars into their economies. They lowered interest rates to encourage spending and investment, bailed out failing banks and businesses, and implemented regulatory changes to prevent such a catastrophe from happening again. The recovery process took years, with some countries still dealing with the repercussions to this day. But amidst this chaos, there were also opportunities. Investors who had the foresight to buy when everyone else was selling found themselves in a position to make significant gains when the market began to recover. Now, knowing what we do about 2008, what similarities and differences can we expect in 2024? While it's impossible to predict exactly what will happen, understanding the past can give us valuable insights into the future. It's a stark reminder that while the market may crash, it also recovers. And for the savvy investor, this cycle of ebb and flow can provide remarkable opportunities. Drawing parallels between the past and the future can be insightful. So let's journey back to 2008, a year that still lingers in the minds of many. The economic downturn was a harsh reality, fueled by a housing bubble and risky financial products. The fallout was global, with markets tumbling and economies going into recession. It was a wake-up call for many, and the effects are still felt today. Now let's flash forward to 2024. The world looks different, the economic landscape has shifted, and we're more interconnected than ever. The potential for a market crash is real, but the triggers may not be the same. 2008 was a tale of reckless lending and unchecked speculative bubbles. 2024, however, could be a story of different economic pressures. Consider the rise of cryptocurrencies and the increasing influence of tech giants. These are elements that didn't play significant roles in 2008, but could be potential triggers in 2024. Also, let's not overlook the role of policy and regulation. After the 2008 crash, governments and financial authorities worldwide took steps to regulate the financial sector more tightly. These measures were designed to prevent a repeat of the crisis. However, as we look towards 2024, new challenges have emerged. The world is grappling with the aftermath of a global pandemic, unprecedented levels of government debt, and a shift towards digital currencies. These are factors that didn't exist in 2008 but could play crucial roles in the coming years. It's also worth noting the differences in the global economic environment. In 2008, the world was just coming to terms with the rise of China as an economic powerhouse. Fast forward to 2024, and we're looking at a multipolar world with several economies playing influential roles on the global stage. This shift could have significant implications for how a potential market crash could unfold. However, we should also highlight some similarities. Just like in 2008, investor confidence plays a crucial role. The fear of a crash can sometimes be a self-fulfilling prophecy, leading to panic selling and a market downturn. Also, while the potential triggers may be different, the fallout from a market crash could be similar. We could see a global recession, job losses, and financial instability. These are consequences that anyone considering investing in the market needs to be aware of. But this isn't all doom and gloom. There are ways to turn a market crash to your advantage. It's about being prepared, understanding the risks, and knowing when to make your move. So, as we look towards 2024, let's remember the lessons from 2008 and be ready to turn potential challenges into opportunities. A market crash, while devastating, can also be a golden opportunity for savvy investors. Now, that might sound a bit paradoxical, but let's dive into it. When the market crashes, prices of stocks plummet. This might seem like bad news at first, but it's actually the perfect time to buy. Why, you ask? Well, think of it this way. When you go shopping, you're always looking for the best deals, right? The same principle applies to the stock market. When prices are low, you get more bang for your buck. This strategy, aptly named buying low, is one of the most fundamental strategies in investing. Now, let's move on to diversifying investments. If you've ever heard the saying, "Don't put all your eggs in one basket," it applies here perfectly. By spreading your investments across different sectors and companies, you reduce the risk of losing all your money if one company or sector takes a hit. Diversification doesn't guarantee you won't lose money, but it's a smart way to manage risk. Another strategy is to hold on to your stocks for the long term. The stock market has historically always recovered from crashes. It might take some time, but those who are patient often see their investments grow over time. This is called buy and hold strategy, and it's a favorite among many successful investors. Now, it's important to note that these strategies are not foolproof. Investing always comes with risk, and it's important to do your own research and consider seeking advice from a financial advisor. But by understanding these strategies, you can better navigate the stormy seas of a market crash. So, while the market crash can seem like the end of the world, for the informed investor, it can be a golden opportunity. It's all about perspective and strategy. With the right approach, you could turn a market downturn into a financial upturn. Now that you're informed, you're better prepared for whatever 2024 might bring. To sum up, here's what we've learned today. The potential for a market crash in 2024 is real, echoing the financial tremors we felt in 2008. The similarities are uncanny, yet the differences are worth noting. In examining the 2008 crash, we've uncovered patterns that might repeat in 2024. But remember, history doesn't always repeat itself, but it often rhymes. It's crucial to understand that a market downturn isn't necessarily a disaster, but rather an opportunity. If navigated correctly, it can be a chance to make significant financial gains. The key is to stay informed, make strategic decisions, and keep a cool head when others are panicking. In the face of an impending crash, preparation is your best bet. Understanding market patterns, having a diversified portfolio, and being ready to make bold moves when the time is right can turn a potential catastrophe into a golden opportunity. Stay informed, stay prepared, and remember, every market downturn is an opportunity in disguise. Until next time, this is your financial guide, signing off.